So I'd like to thank everyone for attending. This is another one of Washingtonians for Public Banking's virtual town hall. It's our second one for this year. Um, we have a real treat today, and we have Ellen Brown speaking with us. Ellen Brown is a pioneer and thought leader in the public banking movement, an author and activist who's one of the founders and your board president, your board member emeritus right now for the Public Banking Institute, or you're still officially on the board?
I'm still on the board, but I'm not chairman anymore.
Yeah, not chairman, chairman emeritus.
Right. Yeah.
But Ellen Brown, who will be speaking on the future of public banking. All right, so take it away, Ellen. Thanks again for joining us.
Okay. I need to share. Is that okay? Is that
Yeah,
set
I
up?
gave you those capabilities, so you should be able to do that.
Cool. Okay. Oh, wait. That's the right one. Oh, here. Oh, why isn't it opening? Share. There. Okay. Beginning. All right. So I'm going to talk on public banking's time to shine. I know it seems like it's dark times, but there is reason to be optimistic. It's when we have crises that politicians actually think about changing things. So this could be our time. Um, so some of this will be old to you all probably, so I'll go kind of fast, but public banking is not a new idea. Worldwide, there are 910 public banks with total combined assets of nearly $50 trillion as of 2020. And nearly 35 trillion of those are in the Far East and Central Asia, mainly China. Publicly owned banks took China from one of the poorest countries in the world to global economic powerhouse in 4 decades. Among other achievements, China built 26,000 miles of high-speed rail in 15 years, along with the world's largest dam and power station. So how did they finance all that? The government owns 80% of Chinese banking assets with nearly, 4,425 banking institutions and 3 massive development banks, which we need to. Government banks funded the projects with credit, so they just extend credit like all banks do, and the fees repaid the loans. The US has only one state-owned bank, the Bank of North Dakota, but it's a stellar model. According to the Wall Street Journal in 2014, the Bank of North Dakota is more profitable and has a better credit rating than either JP Morgan Chase, the nation's largest bank, or Goldman Sachs. And according to the 2023 annual report of the Bank of North Dakota, which is the latest report, it has record net income of $191.7 million, asset size of 10.1 billion, a return on investment of 18.2%. The return on equity averaged over the last 24 years. This was calculated by Earl Stalin. He went through and picked out every year and added them up and divided them. So the average is 19.51%, or almost 20%. In other words, quite remarkable. Over the past 35 years, the Bank of North Dakota has returned 2/3 of its profits to the state on average, with 1 billion returned through 2018, mostly in the previous decade. Standard & Poor's credit rating confirmed that it has been A+ stable for some time, but it was confirmed in January this year, even though they don't have their annual report out yet. A+ stable. Why is it so profitable? It doesn't have private shareholders bleeding off the profits. It doesn't have to pay bonuses, fees, or commissions. It doesn't have any high-paid CEOs. It doesn't have to advertise. By law, all of the state's deposits are deposited in the bank, and all the state's revenues are deposited in the bank, and so it's got built-in deposit base, and it's got a built-in, it doesn't need to advertise for borrowers because it's basically a banker's bank. It partners with the local banks. So they go out and find the loans. And if they have a loan that's too big for them to handle themselves, then they'll ask for the Bank of North Dakota to back them up with it. And so Bank of North Dakota doesn't need multiple branches or ATMs, and it's able to pay its profits to the state and for low interest loans to borrowers and communities rather than to private investors, which of course the mandate of private banks is um, to generate as much in the way of profits for its investors as it can. Whereas the mandate of a public bank is to serve the public interest. The Bank of North Dakota has a century-old legacy. It was founded in 1919 following a farmers' revolt against out-of-state banks for closing unfairly on their farms. The banks and the railroad and the granary were all one cartel, and the granary wasn't taking their grain, even though they thought it was good grain. And so they couldn't sell the grain, and therefore they couldn't pay their mortgages. So they thought they were being, there was an attempt to get their farms. So they formed the nonpartisan league, won an election, and created the state-owned Bank of North Dakota and State Granary, both of which are still operating today. During the Great Depression, the Bank of North Dakota made millions of dollars in low interest loans to the state's farmers, keeping them afloat. It was called North Dakota's mini Fed, but it's actually better than the Federal Reserve. The Bank of North Dakota has no private owners. It's a public lending bank, like the first U.S. bank, which was a lending bank and a depository bank, a real bank that served the people, whereas the Fed at best only serves the banks. It's definitely a banker's bank to backstop the banks. The Bank of North Dakota partners with local banks to fund public infrastructure and social needs, as well as private business and development. It can't print dollars, unlike the Fed, but like all banks, it creates money as deposits through loans, leveraging state funds to increase the local money supply and spur economic development. The global financial crisis and the B&D model together triggered a public banking movement, our movement. North Dakota was one of the few states to escape the crisis. So I knew that it was the only state that had a bank. So I was watching it. And when I saw how well it was doing, I started writing articles, and I got I got so much email that I complained to a friend. I said, I can't answer all this email. And he said, well, why don't you start a Google group, and then they could talk to each other and you don't have to respond to them all. So we did that, and we got like 200 members, and we got some real heavy hitters. There was one person from the Federal Reserve. There were people from the old money reformers from Australia and New Zealand and England. So we learned, that's where we really learned what this whole thing was about. And then in 2010, of course, it was the Occupy Wall Street movement and the Move Your Money movement. So individually, we could move our money into credit unions, et cetera, but there were no local banks that were big enough for state funds. And so that's how, so that the alternative was form your own bank like North Dakota is doing. Then in 2011, the Public Banking Institute was founded, and the first California bill was filed. Altogether, we've had 13 bills, or 5 for the state and 8 for cities. And of course, none of them have passed, unfortunately. But Washington State was first. In 2010, then Representative Bob Hasagawa filed the first public banking bill, which also did not pass, but he is persistent. And this year, after 13 public bank bills, he filed SB 5754, which would create a public bank that would act as a depository institute for the state. Currently, the state deposits its money in 72 different institutions, and most of them are chartered outside the state. So that's money going out of the state, not contributing to the local economy. That bill did not pass the Ways and Means Committee, but it can be revived in the 2026 legislative session, and we're hopeful. Spurred by Occupy Wall Street, the public banking movement has grown, with groups forming in most states. since 2010, 177 public bank bills and other legislative actions have been filed, but we don't have any new public banks except Bank of America Samoa, which is not obviously territorial US, and several tribal banks. Why not? For one thing, people still don't really understand the concepts. They think banking is too complicated and they'll leave it to the experts. I mean, even politicians don't really understand what we're talking about or why we think it's so important for them to do it. But we do have a new tool, which is AI, which I'm really excited about. I mean, you can just get answers so fast. You do have to ask it for sources, but that's what I use it for, the sources. And then I read the source and then I can cite that. Um, then politicians, of course, are afraid of risk. They're worried about making loans with their money. They don't understand that we're actually not lending their money, their specific money. We're actually creating new money, but I'll get to that. And then we're sure we're getting pressure from big bank lobbyists. It's not overt, but we know that they talk to their fellow local bank members, and so there's a lot of political resistance to change in good times, but we're in not necessarily in good times right now. We're in crisis time. And so as Winston Churchill allegedly said, although I guess nobody's pinned him down on it, never let a good crisis go to waste. But Rahm Emanuel said it. And he said, you never let a serious crisis go to waste. What I mean by that, it's an opportunity to do things you think you could not do before. And that's what I think. I think we're in opportunity times right now. So our crises include infrastructure crises. We've had an unusual number of natural disasters lately. Social and health crises, massive layoffs, rising unemployment, and we don't have the money to pay for them. The federal debt is up to $36.2 trillion with a $1 trillion interest tab last year. State and local budgets are squeezed, and many banks are restricting lending due to capital and liquidity problems and non-performing loans, particularly like commercial real estate. So policymakers ask, why do we need publicly owned banks? We already have lots of banks and governments have loan funds. But a major difference is leverage. Revolving loan funds can lend only the capital that they have. Chartered depository banks can lend up to 10 times their capital. They actually create new money for the economy. Private banks can leverage, but they're costly. So this is what the Bank of England has to say about how banks create our money supply. Banks do not act simply as intermediaries, lending out deposits that savers place with them, and nor do they multiply up central bank money to create new loans and deposits. Commercial banks create money in the form of bank deposits by making new loans. Bank deposits make up 97% of the amount of money currently in circulation. Of course, that was for the UK, but the US is similar. I read one Fed figure that said 95%. So today it's private banks, not the government, that issue most of the money supply. In the 19th century, banks would just print their own banknotes that had their own name on it, and they were redeemable in gold. And they knew that they could lend out 10 times as many notes as they had gold because the goldsmiths had established that. People would, in the previous couple of centuries, people would leave their gold with the goldsmiths, and then the goldsmith would give them this gold receipt that represented their gold. And they found that people would prefer to trade the notes over actually coming to get the gold because the gold was heavy and it might get stolen. The notes were very convenient. So, and they knew that they learned that they could lend out 10 times as many notes as they actually had gold, and they could get away with it. So we've had that 10% requirement ever since, although as of 2020, we have no reserve requirement because of COVID. So then, well, we got the first US bank, which issued its own banknotes, and that was a form of national currency. But then Jackson declared war on the banks, and the bank, we had no national bank. So then you had all these state banks that would do the same thing, issue their own paper notes backed by gold. You could redeem it for gold if you wanted to, but most people didn't because it wasn't convenient. But if you were like shipping, or if you were moving gold or you were moving, say you, well, anyway, to move the gold from one bank to another was quite um, difficult. So the National Bank Act was originally passed in 1862, but it was an attempt to get all the banks to join the national bank system and to adopt a uniform national currency. If they were in this system, they could put national bank on the top of their currency, but they had to capitalize it with bonds federal bonds and some gold. And not all the banks wanted to join. So the state banks that avoided this system did it by instead of, they quit issuing, oh, sorry. So there was an amendment that imposed a 10% tax on the state bank notes. So to avoid that, the state banks just quit printing notes. What they did was they would just write the amount of the loan into the customer's account and then give them a checkbook. So basically the customer, the borrower wrote the bank note with these checkbooks where it could issue his own promissory note. Quite clever. And so even today, deposits are counted in the M2 money supply. It's just numbers, it's not paper anymore. And it's certainly not gold. So this is how the bank creates money. If you go to the bank and let's say you want a $500,000 loan to buy a house, the bank will write $500,000 into your account and hand you a checkbook. And then you can write a check to your seller. And if your seller's in another bank, then that bank will get a $500,000 deposit, which will count as new money in the records of how much money is out there because it's new deposits. Now, if that bank did the same thing, had a $500,000 made a $500,000 loan, which went into the first bank. Between the two of them, their books would balance. They wouldn't have to trade any money, and $1 million would have been created that didn't exist before, created in the form of deposits. But typically it doesn't come out even like that. So if you have one bank in this model from Investopedia, you got 25,000 going over from bank A and 100,000 coming in from bank B. So you're going to have a $75,000 deficit or shortfall from bank B. And so that's all it has to pay is 75. You don't have to do the things going both ways. So they net. But it gets quite complicated when you have many banks involved. I mean, you've got banks all across the country and they all have deposits coming in and checks going out and credit cards, deposits coming in and debit cards, etc. So it's quite difficult to keep track of. So the central bank settlement system was a solution to all that. So banks don't just keep customer accounts. They also have an account with the Federal Reserve where they keep reserves, which used to be gold, but now it's just numbers. So they've got two sets of accounts, one with the Fed and one with their customers for deposits. And the banks create deposits as liabilities on their books, but the Federal Reserves are the real money that you need to cover withdrawals or transfers to other banks. And only the Fed can create reserves, and only institutions with master accounts with the Fed can have reserve accounts. So that's one of the snags that we're up against. And where you have all these banks all across the country with money coming in, money going out, they do multilateral clearing. So you don't actually clear with the bank that you got the money from or that you sent the money to, you clear with the Federal Reserve. So, and you only have to tally up what you've got or what your shortfall is at the end of the day or some other accounting period. So then, like at the end of the day, if you're short, then you're supposed to borrow from somewhere else, assuming it. I mean, I think I read somewhere it was like 2 weeks for the accounting period. So at the end of 2 weeks, if you're short, then you borrow from somewhere. You can borrow from the Fed funds market. That means you're borrowing from other banks that have surplus, or you can borrow from the Fed, or you can borrow from the money market, et cetera. But you've got to fill up that deficit. Or maybe you have a surplus. If you have a surplus, the Fed actually pays a nice interest rate on it. So it's a good deal for the banks. So you can have many more trades happening than the amount of reserves you need to back the trades. I saw on the Positive Money website in England that before the global financial crisis, some British banks were leveraging at the rate of 80 to 1. I mean, huge leverage on a teeny tiny reserve basis, and they have no reserve requirement in Europe. So taking it a step further, you could really eliminate the central bank altogether and do it on a blockchain. The BRICS nations are now working on that, although they run into some snags. They don't really trust each other, et cetera. They don't really want to use. I mean, they have trouble. Like, how many? If they get rupees, how many rupees can they use, or how much cloth? Dresses, etc. Can they use it? So anyway, it's difficult, but that's the plan, is a blockchain based system where you might not even necessarily have a currency that you use. It's just all numbers. Banks acquire reserves from incoming deposits or by borrowing from other banks, the Fed, or the money market. The reserves then go into a pool, which is tapped for withdrawals by both depositors and borrowers. So you're okay at a 10% reserve requirement, theoretically. But if you go over that, you risk triggering a bank run. And we've seen that you can actually risk it even if you have 10% reserves. Take the example of Silicon Valley Bank, where over the course of 3 days, there was an attempt to withdraw 85% of the deposits in the bank. So what went wrong with that bank was that they typically, you're making loans to your own customers that put deposits in your bank, but these were tech startups that had lots of money. They were getting the money from the venture capitalists. And so they just needed a place to park their money. They weren't looking for loans. So the Silicon Valley Bank did that. They wanted to make a little money with their excess. So they did what was considered the safe thing, which was buy federal securities. But at that time, the interest rate was so low that later, when they had this run on the bank, they couldn't sell the bonds at anywhere near what they had paid for them because interest rates had gone up and nobody wanted the old low interest bonds. Plus, some of the bonds were marked hold to maturity, so they couldn't sell them under any circumstances. So they, needless to say, went bankrupt. And that run was triggered by social media and short sales of the bank stock. So the social media people were saying, get out of the bank. It's, that's tanking, because the stock was tanking, but that didn't necessarily mean the bank was tanking, but that's what happened anyway. So we have other banks now. Well, there were two other banks at the time, Signature Bank and First Republic, that had the same problem brought down by massive short selling. At that time, the Federal Reserve and the FDIC and the Treasury rushed in to save this day. But we can't count on that because it was considered systemically too risky, but like it would trigger bank runs all across the country. But we can't count on that now because certainly not for small banks that go bankrupt, because the Dodd-Frank Act said no more bailouts. We're supposed to do bail-ins. They're supposed to use our deposits for capital. So we have 200 more banks that have unrealized losses in federal securities that haven't collapsed yet because they haven't been attacked by short sellers, but they could go down at any time, and they're certainly risky, particularly because of the real estate situation right now. So what could trigger it? We have a $2 quadrillion derivatives time bomb out there that is people are definitely worried about, including Warren Buffett, who said in 2001, I think it was, derivatives are financial weapons of mass destruction, carrying dangers that, while not latent, are potentially lethal. Well, they're not. That was like 25 years ago. So this could be the end of the line here where they're going to blow up. $2 quadrillion is 10 times global GDP and 3 times collective world wealth. So there's no way that they could be bailed out. And what triggered the last credit crisis was credit derivatives, but today it's interest rate derivatives that are dominating the derivatives market. Um, Derivatives started out as a good thing. They were actually supposed to protect farmers so the farmers could sell their produce forward. Like they don't have the produce yet, but they would sell the right to collect it when harvest time came in. And then they could use the money to buy equipment and seeds and so forth that they needed to actually do the harvest. And then when it came in, they would sell it for whatever the fixed price was in their deal. So both parties got a good deal. The farmers knew that they could sell their products at a certain price, and the buyers knew that they could buy products at harvest time at a certain price. But before 2000, the derivatives were considered like bets. So you couldn't enforce your bets in court. But after the Commodity Futures Modernization Act was passed, court enforcement of speculative derivatives what was allowed, and that's where the market took off. So deregulation basically caused that problem. But the main problem is that if a big bank, a big derivatives bank goes down, derivatives have super priority in bankruptcies. That means they go first. And that's in the bank. They take all the revenues, and they're going to take everything because it's just such a huge amount of money. So they take before the secured creditors, and now the states think that they're secured, so they're okay because they're collateralized, et cetera. But their collateral is going to disappear along with our deposits because the derivatives take is going to be so big. So that's all in the Bankruptcy Act of 2005, the UCC sections 8 and 9, and the Dodd-Frank Act. So most states hold their revenues in big Wall Street banks, but it's risky for that reason. The riskiest are the biggest. So JP Morgan Chase, which is the nation's biggest bank, now has over $60 trillion in notional derivatives. The bank, so it's a very risky bank, even though people think it's very safe. So the Bank of North Dakota has been called America's safest bank. It was by this podcaster who is obviously a North Dakotan, but also Kevin O'Leary talked about it in a podcast. Why is that? Well, first of all, there's no risk of bank runs. The state owns the bank. It's not going to run on itself. It doesn't have private shareholders who could short the stock, so there's no reason to get all upset. It has a captive capital and deposit base. It has an A+ credit rating. It doesn't do risky derivatives trading. It holds a few derivatives, but they're just like for its own protection for interest rates, et cetera. They're not gambling in it. And it's never been fined for federal regulatory violations, unlike JP Morgan Chase, which has had fines and settlements of $40 billion since 2000 for regulatory violations. So not necessarily where you want to, the people you want to trust. There's the bank run risk. They have deposits of over $2 trillion, over $1 trillion of which are not covered by FDIC insurance. And the fund itself, the FDIC fund, only has $116 billion in it, which is only 5% of all of JP Morgan's deposits and only 10% of their insured deposits. Then there's the derivative risk. Besides the the anyway, the number I said it before. Anyway, there's the netted derivatives where you cancel them out against each other is 628 billion. But Credit Suisse, which was a big global systemically, it's systemically important is what it stands for, but what they really mean is systemically risky financial institution. It collapsed in March of 2023 with only 1/5 as many derivatives, netted derivatives, as JP Morgan Chase has. So they're on thin ice there. Then there's the commercial real estate market risk. JP Morgan Chase is the largest US holder of commercial real estate, and then the fines, et cetera. So besides being run proof itself, the Bank of North Dakota also protects local banks from runs. It partners with the local banks, helps with liquidity, capitalization, and regulation. It buys community bank loans to provide liquidity in a crisis, or takes a partnership interest in them and guarantees them. Provides correspondent banking services, check clearing, cash management services, loan guarantees, and other bankers' bank services. And it has a pre-approved Fed funds line set up with every bank in the state. And for all those reasons, it's endorsed by the North Dakota Bankers Association, which, I mean, we've run up against our local bankers associations, which are on the other side, but that's because they're dominated by the big Wall Street banks. The Bank of North Dakota protects against banking deserts. Nationally, community banks have shrunk from over 8,000 in 2008 to 4,250 today, leaving banking deserts, whole communities without banks. North Dakota, on the other hand, has the most local banks per capita of any state in the country. Why is that? Because the Bank of North Dakota partners with them, augmenting available capital and liquidity and alleviating risk. It also serves as our rainy day fund and is available for disaster relief. It has a cheap and ready credit line with, so the state has a cheap and ready credit line with the Bank of North Dakota, reducing its need for wasteful rainy day funds, which typically would be invested somewhere out of state at some modest interest. And the Bank of North Dakota is also available for disaster relief. Sort of a landmark case was the 1997 Grand Forks flood, which was quite devastating. And the Bank of North Dakota was immediately on the job, unlike we've gotten a lot of complaints about FEMA with the floods lately. So they had $70 million in ready credit lines were extended for the city, the State National Guard, the University of North Dakota, et cetera, individuals, businesses, farms. They worked with federal agencies for forbearance on student loans and federally backed home loans. They reduced interest rates on existing family farm and farm operating programs. And remarkably, no lives were lost, and the city was quickly rebuilt and restored. Bank of North Dakota was also responsible for North Dakota distributing unemployment benefits through community banks coordinated by the Bank of North Dakota 10 times faster than the slowest state. Small businesses in North Dakota secured more payroll protection program funds per worker than any other state. And this is all coordinated by the Bank of North Dakota. Public banks lend countercyclically. So that chart is from the last financial crisis, and it was among Latin American public banks, of which there are many. So the blue is the how much, so the public banks were extending more credit than usual, and then the yellow is the private banks were extending, withdrawing their, tightening their lending standards, withdrawing loans. A public bank can lend to qualifying local businesses at cost. They don't have private shareholders demanding high profits. Then there is what you could save, and typically states fund infrastructure and long-term projects with bonds, but the bonds are quite expensive. So the interest and fees can be half the cost of the project. For example, the Bay Bridge retrofit in San Francisco several years ago, the taxpayers were told that it was a $6 billion project. But by the time it was done, it was a $12 billion project because of interest, doubled the cost. And that money, of course, did not stay in San Francisco. It went probably mostly out of state. So if you own the bank, you save on interest, save on fees. In 2020, local governments paid 160 billion just in interest to basically to Wall Street. And the fees go to big private banks and profits go to wealthy private bondholders, largely out of state. So money is siphoned out of the local economy rather than adding to it. The whole process is quite expensive. According to Moody's, municipal bond default is very, very low, extremely low, very, very unlikely that a city would or a state would default. And much higher for corporate bonds, and yet it costs more for state and local governments to get bonds than for corporations to. Uh, And again, the bond underwriters get the fees, and these are not necessarily people you want to trust. They've been caught in collusion, bid rigging, bad swap advice. So to avoid that, some local banks have actually been borrowing directly from banks. Sorry, some local governments have been borrowing directly from banks. 20% of new municipal borrowings are direct loans from private banks. They have lower rates, fewer regulatory hurdles, that you can avoid fees for rating agencies, credit enhancements, bond trustees, attorneys, and you don't have to go to the voters for approval. Plus, if you have a bond issue, let's say it's for 30 years, you're paying interest over the whole 30 years, even though you're only paying out bit by bit. So if you have a credit line with a bank, you only have to borrow that bit that you need right now, and hopefully you can pay that off without having to pay interest for 30 years on it. So that's just with one of your local banks. And if you're borrowing from your own bank, obviously you're saving even more money because the interest and fees stay with the state or the city. The Bank of North Dakota's profits are generating without taxation, so they actually lower the tax rates. North Dakota had a taxpayer surplus ranking, has a taxpayer surplus ranking number one in Truth in Accounting's annual financial state of the states report in 2024. North Dakota had a taxpayer surplus of $55,600 per taxpayer. And you can see down at the bottom that California is way down low on the list. So we've got a deficit per taxpayer. North Dakota was also rated by Forbes magazine the best state in which to start a business in 2024. So to sum up, the local governments do lend through revolving funds, or California, for example, has an infrastructure and development bank, but it's not a real bank, it's a revolving fund, like it can only lend what it has. But a depository bank can do more. It can leverage its capital at 10 to 1, so it can lend 10 times what it has. For liquidity, it can borrow from depositors, the Fed, or the other banks through the Fed funds market. Can provide affordable credit for local government, local business, local infrastructure, affordable housing, community land trusts, worker co-ops, other underserved sectors. It can also increase the money supply and stimulate economic activity, partner with local banks and act as a mini Fed for them, protect against bank runs, lend when private banks are pulling back, and rush financial aid in emergencies. So to sum up, why it's public banking's time to shine. Churchill said, you can always count on Americans to do the right thing after they've tried everything else. So I think that's where we are with the states. I mean, they're pretty strapped right now. They need a new source of funding. So 49 states have balanced budget requirements. So that means They can't just keep, unlike the federal government, which just keeps borrowing and borrowing and borrowing, states can't do that. And at least 8 states started the fiscal year this year in deficit or with projected deficits. It's been an extraordinary year for disasters with no ready funding for the needed infrastructure. Bonds are very expensive, and then there are threats of defunding by the federal government, particularly in California. So public banks don't just save money, they actually generate money. They are a new funding source for the state or city. We have a proven model. North Dakota has weathered all of the financial storms of this century and come out with budget and taxpayer surpluses. We, the public banking advocates, have 15 years experience now and dozens of legislative models and voluminous resources for proving the case. And now we have AI to find detailed data to back up our projections, which I'm just finding is remarkable. You do have to check it. Sometimes it makes mistakes, or like I always ask for sources, and I mean, I've got Copilot I've caught in making mistakes, and it's very polite, it's really the ideal research assistant, and it'll say, oh, sorry, you're right, and then correct it and come up with some other stuff. So it's really very good if you know how to work it. And any question, like there are things that I've known for 10 years and I'm not quite sure of. So even just doing this PowerPoint, I'd make a statement and I'd say, can you confirm that? And so it's just very handy for all those things that we haven't been able to do. I ran through Grok. I actually like Grok. Grok is better than Copilot, I think. But anyway, I ran through how much could California save if it turned its iBank into a depository bank. And so it gave me like 6 pages of calculations and came up with some great numbers. But unfortunately, it doesn't, when I ask for sources, it says, well, I can't really, that it had gleaned that from many sources. And so it's kind of an estimate. But anyway, it had a lot of numbers and things to think about. And Scott Baker did the same for the pension funds and for the California pension funds and California iBank, et cetera. So it's just stuff that you could spend months on. I spent years trying to figure out what banks that California kept its deposits in, and it could just come up immediately. 80% of them were out-of-state banks, as I suspected. So anyway, that's all I got. For more information, there's my 3 books on the subject, publicbankinginstitute.org, and my website, ellenbrown.com, and of course, the Washington State website, which I'm sure you all have already. Thank you very much.
Well, thank you, Ellen. Thank you so much for that very informative presentation. We already see some hands that have been raised for a question and answer period. We do have about 15 minutes left for question and answer and discussion. I'm just going to read off the hands in order that I see them come up. We have opportunity to ask Ellen a question. So first up, I have Ronnie Phillips.
Okay. Can you hear me and see me?
Mm-hmm.
I can hear you, can't see you.
Okay.
Oh, there. Yeah.
Thanks, Ellen. I enjoyed your talk, and I've read your book on public bank solution, and I agree completely with you about public banks would be good, and Bank of North Dakota is a great example. Now, what I'm wondering is there are a couple of things happening that might improve the chances for the public banks. One is, do you know about this Custodia Bank in Wyoming? They are wanting to get into the crypto business, but they want to be strictly a depository bank. So you can deposit your Bitcoin there, and it's going to be backed 100% by holdings of safe assets. Now, they would like to then join the Federal Reserve, and they would be fully in compliance with everything. They're already a chartered bank in Wyoming. Now, since the Trump administration, they've done a lot of weird things, but they're also into this crypto. Now, if they were to allow, with Tim Scott as head of Senate banking, they've got some legislation. If they were allowed this bank into the Federal Reserve payment system, then that opens it up for lots of other banks. Just like, I mean, we know the American Bank of Samoa was able to get in to the Fed's payment system, but if they get Custodia Bank in, that opens it up for other types of banks. The problem is the Fed won't let these banks have master accounts. That's the big thing. The other thing is, of course, all the states that have legalized marijuana, they can't put the, banks would like to have those deposits, but they can't take them because of federal regulations. Well, if states could take the marijuana money and start public banks, that would be a great way to do this. So that seems like two things that are happening that could really push the public bank argument forward. Do you have any comments on that?
Yeah, I agree. In fact, I wrote an article on that.
Oh,
There was a law review article that cited that the Custodia Bank case, and it said there were various types of banks that were questionable, or that had been questioned, or that were being squeezed. And one of them was public banks. So we were in that same category. I mean, the problem is getting FDIC insurance. That's a requirement to get a master account with the Fed. And there's a question whether we can get FDIC insurance. Although I have heard that there are people seem to think they can get FDIC insurance. So we may get around that anyway. But I agree, there's so much change going on that there's even though there are things that seem negative, there are also things that could be positive. I mean, just lifting the regulations on the banking charters is an excellent move for our benefit. So thanks for bringing that up.
yeah, and I don't think the banks have to have the FDIC insurance. There are banks with access to the Fed's payment system that aren't FDIC insured. I'm pretty sure, and there's not many, but it's really a decision by the Fed and putting pressure there. So we'll see what happens. Thanks.
Okay,
Thanks for your comments.
Next up, we have Pan Kitzner.
Ingrid.
So we have Pam, Vicky, then Ingrid.
Oh, okay.
Okay, so Pam, go ahead.
Okay. Hi, I'm Pam, and I'm not quite as knowledgeable about all this stuff, but I have a question for you, because a lot of my friends use credit unions. So what does this do to credit unions?
Well, if we follow the Bank of North Dakota model, it partners with them. Just they're one of the local banks that gets the benefits of partnership in North Dakota. A credit union is, I mean, you couldn't really use a credit union for a state bank because, okay, too small, but it'll definitely benefit. In fact, we have some chairmen of credit unions that are big supporters of the public banking movement, I think in New Mexico anyway.
Oh, okay, thank you.
All right, and then next I have Vicky and then Ingrid.
Okay, thank you. I'm sorry I missed the first part of your talk. It sounds like it was very informative. Just a quick question. Is someone out of state allowed to bank at the Bank of North Dakota?
No, unfortunately not. And it has very few individual depositors. Most of its, I think 98% of its deposits come from the state, because they don't make it easy to be a depositor there. I mean, you almost have to live right near the bank. They don't have branches, and they don't have ATM machines. And but they thought, well, it was the state bank, they should open it up to individuals. So they have a few, but not many. But no, they don't take out of state.
All right, and then finally I have Ingrid. And then that was the last of the initial hands that went up. So if anyone wants an additional question, please just raise your hand and I'll call on you. Go ahead, Ingrid.
Yeah, Ellen, first of all, does North Dakota have FDIC? Are they FDIC with some of their accounts,
No.
or no, because they're too big?
No, it's because they were grandfathered in. No, nobody worried. The FDIC itself wasn't established until 1935. Is that right? Does anybody else know? Anyway, in the 1930s by,
Would that
under.
be established with like the new banks now that are the new uh state banks? Would that be established? I don't know. But I thought it was just a curious question, but here's what I'm wondering. So North Dakota, I assume, does all their infrastructure there because they have the money to do that. They don't ask the government for it unless the government just hands it to them, right?
I would have to research that, but I assume, I mean, I'm sure they do have a lot of money for infrastructure, so.
The other thing I wanted to ask is because I forget his name, I can't pronounce his name, Hawasaka, the senator, um,
Bob
the
Hasagawa.
senator, yeah,
Yeah,
thank you, Hasagawa.
Yeah, Senator
I
Bob
keep,
Hasagawa.
yeah, so when the National Infrastructure Bank put their proposition or their thing together, it was passed. And then we took it to the city and that passed too. So we've had quite a few successes, and I would think that maybe um maybe redoing the verbiage or something like that, that would be a little there might be something more that you could do to present to them that would convince them um that this is a good idea. And the other thing that we did, which I think would be helpful, is we contacted all of our representatives, the state representatives, and or not maybe all of them, but many of them, so that we could get them to vote for this. And we also contacted the city council. So it wasn't like we just threw this out there. We we battered them up and then that we got it passed. So I'm wondering if that's kind of the one thing. And then the second thing is people really don't understand the bank. And it's really it seems like we should have like, the build thing with the ABC and how they did for kids, that little cartoon. They should have this for the National Infrastructure Bank and for the state banks because people just don't understand it. And yet it's once you understand it, you go, wow, that's cool. So
Yeah,
that might be
Ingrid,
another
just
reason.
just for clarification, you're referring to the resolution that was passed through the legislature for the
Yeah,
National
yeah. I
Infrastructure
mean,
Bill.
it wasn't passed as
Yeah,
anything except that they
yeah,
support it. Basically, it was supporting it,
yeah.
not
Just
doing anything about it. But I'm thinking
just
maybe the resolution, another resolution would help or something.
yeah, just for everyone who's maybe not familiar with this in the group, on them today. So there is a movement for to create a federal national infrastructure bank, which is like a federal bank that would be dedicated to infrastructure.
Not
Um,
federal, national, and the federal has
national,
nothing to do with it.
well,
And taxes.
it'd be put by the federal, charged by the federal government, by the national government. Our
Well, it wouldn't
state
be in
has
charge by
passed
the, I'm just sorry, it
passed a
wouldn't be in charge.
resolution. Our state has passed a resolution in support of that, and some of our cities have too. Seattle has, and Bellingham. And Bellingham has also passed a resolution in support of creating a public bank here in Washington State.
So yeah, I would think that we can maybe campaign and push it a little because I agree with Ellen that this is the time to do it. It's a disaster. Whatever's going on is a disaster. We need to come up with better ideas.
yeah, thank you. Yes,
Thank you.
I
And oh, Ellen, is there a way we could get a copy of your slide? Because it was so informative and I forget every time when people put these presentations together, it kind of goes out of my head. Do you have, I
yeah,
don't know if it's proprietary or whatever.
sure, I sent it to Marco, so.
Yeah, I
Okay,
can send it all off to everyone who registers for the event. We have your registration in the Zoom account. So as a follow-up, I can send all the people who registered a copy of the presentation. All these presentations are also located on our YouTube channel where we post all our virtual town halls. So if you want to watch
oh,
it again,
okay,
you'll have an opportunity to um, refamiliarize yourself with the information.
okay.
Any other questions? I do see a comment in the chat from Ronnie. Ronnie, do you want to share your comment with the group?
Yeah, it was just thinking about the FDIC. The permanent FDIC was 1935. Bank of North Dakota was, of course, 1919. But the other thing, the Bank of North Dakota was able to get a master account with the Fed because it was so early. It took the Fed, even though the Fed's bank started in 1914, they couldn't get everybody involved in the payment system. Eventually, the Fed established the Fed wire, and then the Fed said, "We'll ship gold for free," and so that pretty much put everybody else out of business in terms of the payment system. But the Bank of North Dakota was able to squeeze in because the Fed wanted banks to join their payment system, their Fed wire. So they lucked out.
Yeah,
Oh,
that's great. Thank you.
interesting.
And then we do
Yeah,
have,
could you imagine if all the money was coming from Washington into the bank, how much money we would have? That'd be great.
Yeah, and
But-
if you can leverage it out, then you can have 10 times that amount in terms of
Mhm.
credit. Yeah.
we do have Ruth who has her hand up, and I do want to introduce Ruth. She is a board member on Washingtonians for Public Banking. So Ruth, go ahead.
I was just going to mention, I put two alternative news sources for banking and finance. One is Wall Street on Parade, and the other one is Naked Capitalism. And I also included sort of a third party assessment of how biased or unbiased they were, because I'm a big one to think that sources of information are extremely important to whether you believe them or not. But in any event, those are two very good. If you start looking through them, you will sort of learn by absorbing part of what they're saying. And they will say things ahead of what you will hear about in the real news, regular, not real. Oh, geez.
And whatever news.
Government news, whatever. So I just wanted to point that out to people if they wanted to look up those references. I think they would be good resources, including PBI and WPB, our local groups, and the National Institute. The Public Banking Institute, which is an excellent source. That's up there with all of the good ones.
Thanks, Ruth. And thanks for all your work.
Mhm.
Both of you are.
Well, we
Delighted.
have reached our time for this evening. Is there any final questions? I'm not seeing any, so I just want to thank Ellen again for joining us for our virtual town hall. Again, this is our second virtual town hall. Our next one, which we're going to have another 2 months, is going to be on the National Infrastructure Bank. So that to come up now, we have an expert on that. So if you want to find more about the efforts to create a National Infrastructure Bank, you can come to that event as well. We also have an upcoming event, Washingtonians Public Banking. I'll be talking to the Thurston County Land Trust. That is going to be happening on April 10th, and it'll be at the Lacey Timberland Library at 500 College Street. So if you're in the Thurston County area or you live in Lacey, you can come to that event as well. It's going to start at 6 o'clock. So thanks again for everyone attending. We appreciate it. Please, if you haven't signed up already, go to our website and sign up for our newsletter where you can get more information about upcoming events, about public banking and financial reform, also about legislation that we're following in the State House and what we're doing to move this movement forward. All right. So thanks, everyone. Have a great evening.
Thank you.
You too. Bye. Thank you.